Hello and welcome back to our channel. Today we're going to talk about how to invest in index funds. If you've been following us for a while, you know that we love talking about personal finance, investing, and financial literacy. So, let's dive right into it. What are index funds? Index funds are investment vehicles that aim to replicate the performance of a specific market index such as the S&P 500 or the Dow Jones Industrial Average. They do this by holding all the stocks in that index, which helps them achieve their goal of tracking the overall market return. Some key points about index funds include diversification. By owning every stock in an index, investors get exposure to hundreds or even thousands of companies without having to pick individual stocks themselves. Low costs. Since they don't require active management like actively managed mutual funds, index funds typically have lower expense ratios, making them more cost-effective options for long-term investors. Passive management. Unlike actively managed funds, where fund managers try to beat the market, index funds simply track the market. This means they generally perform better over time because they avoid the high fees associated with trying to outperform the market. Why should you consider investing in index funds? There are several reasons why you might want to consider investing in index funds. Lower risk. Diversifying your investments across multiple asset classes can help reduce risk. Long-term growth. Historically, the stock market has provided higher returns than other types of investments over the long term. Ease of use. Index funds are simple to understand and manage, making them accessible to both experienced and novice investors. Types of index funds. There are two main types of index funds: exchange-traded funds ETFs and traditional index funds. Exchange-traded funds ETFs. These are similar to stocks and trade on exchanges throughout the day at prices set by supply and demand. ETFs offer many advantages, including low costs, tax efficiency, flexibility, and liquidity. Traditional index funds, also known as open-end index funds. These are priced once per day based on the net asset value of the underlying securities. Traditional index funds are simpler to use but may not be as flexible or efficient as ETFs. How to choose the right index fund for your portfolio. When selecting an index fund, consider factors such as fees. Look for funds with low expense ratios, as these will save you money over time. Asset class. Determine whether you want to focus on domestic or international equities, bonds, or a combination of both. Investment style. Decide if you prefer broad market exposure or sector-specific funds. Risk tolerance. Assess your comfort level with volatility and choose funds accordingly. That wraps up today's discussion on how to invest in index funds. Remember, diversification is key when building a well-rounded portfolio. By understanding the basics of index funds and choosing the right ones for your needs, you can take advantage of the benefits they offer and work towards achieving your financial goals. Thanks for watching, and don't forget to subscribe and hit the notification bell for more great content.